The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The Fed decides and the markets react. Welcome to The Close. This is Romaine Bostick.
And I'm Katie Greifeld.
You are certainly Katie Greifeld. Of course, we are just about 10 minutes until the closing bells and about 30 minutes removed from the Fed's last meeting and press conference of 2025. And here is the lay of the land here. A 25 basis point, which came as expected. The third straight cut that we've gotten out of the Fed in the last three meetings. And we should point out, though, the policy projection for 2026, just one more quarter point rate cut heading into next year. But the two biggest developments of this meeting, one, the resumption of those Treasury bill purchases, an acknowledgement of a potential crash crunch going on right now in the short-term money markets. And number two, the era of Fed congeniality apparently over. For the fourth straight meeting, we've seen dissents, and the dissents at this meeting, three, the most we've had since 2019. Here's Jay Powell just moments ago.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
You take a look at the market reaction. The knee-jerk reaction to the Federal Reserve's chair comments there, you can see, has been to buy stocks and to buy bonds. The S&P 500 set to close at what would be a record high. The Russell 2000 as well, higher by about 1.4%. That would be an all-time high for the small cap index as well, helped by what we're seeing in the bond market. A bit of relief coming through across the curve. That 10-year Treasury yield, which we've been keeping a very close eye on, down nearly 5 basis points right now. And the ultimate risk asset, you can see as well, catching a bid on the heels of this meeting. Bitcoin higher just a little bit, about 0.1%, Romaine.
Ken Shinoda joins us right now, portfolio manager over at DoubleLine Capital. And a little bit earlier, before the Fed meeting, Ken, we had a chance to catch up with Bob Michael over at JP Morgan Investment and Management. And I thought it was kind of interesting. His reaction to this report was basically, in his words, it was not as much as the market expected, but not as bad as the market feared. What did you make of today's decision?
Yeah, I think the market expected more of a hawkish cut. That's why the Treasury curve had been selling off for the last couple of days. I know we're rallying today. We're basically back to where we were at the beginning of last week. I kind of view it as a pretty balanced Fed with maybe a dovish tilt. And I think one of the things that led to that bond market rally was the announcement of Treasury purchases, T-bill purchases. We joked on the desk here that we're doing quasi QE again.
Well, that's what I'm curious about. I mean, let's just point out, he avoided calling it QE, but is that effectively what it is? And I guess more importantly, Ken, why do you think they felt the need to do this now? I know there had been some pressure coming out of the folks in the Treasury market saying that the Fed needed to step back in. Was that the reason?
Well, I think you're seeing a little bit of lack of liquidity in the repo markets, and going into year end, they want to keep that liquidity high. So I think it's really to kind of support those repo markets and balance sheet liquidity out there.
And let's talk a little bit about the bond market reaction, because, again, you see that over the past couple of weeks, there's been this rise in the long end, and there's been some concern about what that means. You're seeing 10-year yields in particular come in a little bit today. I wonder how you're thinking about some of the movements on the curve and whether the respite maybe that we're seeing is something that's going to be sustainable.
Well, we've been trading range bound, and 4% on the lower bound has kind of been a sticky spot. It's been hard to break through, and I don't think the bond market can break through that 4% without considerable weakness in the labor market. And I know the Fed's definitely concerned about that. They mentioned it a couple times, and I think it's the labor market data that has led them to their cut today. One thing that Powell noted is that the payroll numbers have been coming in around 40,000, and they actually think they're overstated by about 60,000, which means we had negative payrolls. And I think that's a main reason they cut. Now, the other thing the market's concerned about, and it comes and goes, is fiscal concerns about too much spending and the interest costs on on outstanding debt that continues to rise. So I think there's this push and pull between weakness in the labor market helping long-term rates fall, and then concerns that deficits are already high and we're not even in a recession. So if we go into a recession, I'm not saying that's my base case, that would mean even more spending has to come. So this is the push and pull that the long end of the yield curve has to deal with right now.
Absolutely. And the result, as you mentioned, has been sort of a range-bound trading environment. But let's take a look into next year, because I thought it was interesting to hear the chairman say that this further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend towards 2%. That could be setting up a pause here when you think about both sides of the dual mandate and the threading that they need to do. How did you read that comment? And if we are headed to a Fed pause, which may extend at least until May 2026, what does that mean for you in your seat as a portfolio manager?
I definitely think it's possible. He mentioned many times that we're in a good place. I think he said we're in a good place 5-6 times, which means that he feels that they're at a good spots. And I think short-term rates have now come down to where the 2-year is. The 2-year had come down much more than policy rates, and we're now pretty close to the 3% neutral rate that many market participants believe is where we should get to. So I think with inflation kind of remaining sticky at that 3%, that gives them the potential to stay on hold and wait for data. And so they're really going to be relying on that labor information come through.
When you look at longer term yields, though, Ken, I mean, do you get a sense here that we will see a more meaningful resumption of the steepening of the yield curve? Not so much just because of what the Fed is doing, but obviously with a lot of the other noise going on in the background, whether it's the deluge of corporate issuance on the AI side, the increase in the term premium, et cetera.
I think all those things are part of it, and also what's going on internationally. I think one of the reasons we saw this recent move was they're starting to talk about rate hikes over in Europe. Yeah. And in Japan, that could continue to happen too. So, in other parts of the globe, you're seeing inflation kind of pick back up. So if you're starting to see hikes over in Europe, it's going to be hard for the long end to rally.
All right, Ken, always appreciate the quick and instant analysis coming out of these Fed meetings. Ken Shinoda, portfolio manager over at DoubleLine Capital. And we should point out, Katie Greifeld, you take a look at markets right now. And I was looking at the most recent meetings, the last 4 or 5 meetings. The S&P has largely been flat on those meetings. A big change today with the S&P trading at a record high. Absolutely. A big reaction here. Also in the small cap. So it's really across the size spectrum, that positive reaction. Record highs potentially for the S&P, the Russell, as well as bank stocks. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with the global simulcast. We're joined now by Carol Massar and Tim Stenovic from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on Fed Day, the last Fed Day of 2025. No surprises in the cut, but maybe a little bit of confusion about what comes next, Carol.
Yeah, absolutely, which is something we've been talking about all week, right? And that's what everybody wants to know, what comes after this meeting. Having said that, definitely seeing some outperformance in terms of the KBW Bank Index. That's up about 2.6%. We also, we just mentioned, too, we're watching shares of Warner Brothers Discovery up about 4.5%. President Trump saying any Warner Brothers deal must include a sale of CNN. So certainly this gets more interesting, and it makes you think what deal is going to happen.
Why does it need to include a sale of CNN?
I don't know. We're going to have to find out from the president.
But remember that Netflix's offer does not include acquiring CNN. It doesn't include acquiring those traditional cable channels. It only includes the studios. So what he would be speaking about ostensibly is Paramount Skydance's deal, which includes, all of Warner Brothers Discovery.
Yeah.
Well, we've certainly heard a lot of opinions on what is going to happen. Now we have the president chiming in as well. We know that this deal is going to take a long time to play out. Certainly got a little bit more interesting, but so too are these markets in terms of being interesting when you consider the S&P 500 moments away from a record high.
So let's go back. So we have Trump also speaking at the White House, decided to hold this meeting at the same time Powell was speaking. He is also addressing the issue with regards to interest rates as usual, making the case in his words that apparently Jay Powell has not done enough. He's also talked about the selection process for a new Fed chair, said that he's meeting today with Kevin Warsh. So a lot of what comes next for the Fed, of course, will depend on who's in that Fed chair seat come May of 2026, and maybe we get a little more clarity on that in the weeks ahead. Meanwhile, here on this Wednesday afternoon does look like record highs for at least two of the major indices. The S&P 500 is going to close higher, 6,886 and change, up about 46 points or 0.7%. That's a record high. The Dow Jones Industrial Average up almost 500 points or 1% on the day. The NASDAQ Composite adding about 0.3%. And the Russell 2000 up about 1.3%. And that is also going to be good enough for a fresh record high. We should also point out that the KBW Bank Index also closing today at a fresh record high.
Yeah, real surge in that, no doubt about that. And that Russell also moving significantly, as you mentioned, Romaine. So really some standout. Hey, S&P 500, let's go back to the big caps if we may. 389 names in the S&P 500 higher today, 113 to the downside, and Katie, one unchanged.
Let's take a look at the sector level here. Broad breadth overall, 9 of 11 sectors finishing in the green. You can see that big tech finished just a hair higher. It was industrials, really, though, that stole the show, up by 1.8% as a sector, followed by materials and consumer discretionary. In terms of what didn't perform on this Fed Day Wednesday, utilities down about 0.1%, and consumer staples pretty much flat on the day, but slightly red, Carol.
All right, let's go to some of the individual gainers. GE Vernova, shares climbing 16%, biggest one-day gain on record. So this stock soaring. It's the top performing stock in the S&P 500 today. The company doubling its dividend, increased the scope for share buybacks, and raised earnings projections. Keep in mind, this is a company, we've been talking about this here, right, that it has really benefited for the soaring U.S. demand for electricity, whether it's data centers, AI largely, and just really the overall electrification of the economy. That stock is up about 118% year to date, and so quite some outperformance there. Let's go to Warner Brothers Discovery, because this one certainly on my list. I think it was a top gainer in the NASDAQ 100, 4.5% to the upside. We just got some comments from President Trump saying that any deal for Warner Brothers Discovery must include CNN, and as we pointed out, that deal, the offers that we've gotten, Paramount includes the CNN property. The Netflix deal does not. But nonetheless, Warner Brothers Discovery, it's up about 4 days in a row, a gain of about 16%, up 135% since September 10th. And just for something different, Dave & Buster's, I know it's a small cap company, plays the ticker, up about 13% in today's session. This is Wall Street analysts highlight improving comp sales trends in October and November despite a third quarter miss. And during the conference call, the company did come out and say that traffic at its dining rooms late in the quarter was meaningful, up year over year, with October same-store food sales being the best month of the year and improving in November. Stock is down about 31% year to date. 38% of the float is short. So
hey, I just want to add an honorable mention in there too,
Please.
Carol. Keep an eye on shares of Cisco, which have been rallying now for 7 straight days, adding 0.9% on the day. And that's actually going to be good enough for a record high, and significant because it hasn't hit a record high since the dot-com bubble burst all the way back in 2020, the first record high for Cisco in 25 years. And I bring that up as well because, of course, we talk about some of these old tech stocks that have found some new life here in the AI era. We are expected to get earnings a little bit later today from Oracle, which, of course, hit a record high back in September.
Well, before we get those earnings, let's go over some of the other movers to the downside today on the day. I do want to start with shares of Netflix, down 4.2% today, 6th session in a row to the downside. This is the longest losing streak going back to January. Now, over this time, the last 6 days, it's fallen 15%. That's the worst since 2022. This all as the bidding war for Warner Brothers Discovery heats up. And just a reminder of what we heard from the president moments ago at the White House. He says that any Warner Brothers deal must include the sale of CNN. Also, Paramount out with some headlines, too, saying that the Netflix cash component is about $7 a share lower. Paramount also says in a letter that its $30 a share offer is superior. So like Katie said, this story is one that continues, but Netflix has taken a hit over the last few days as a result. Also, large hospital chains, including HCA Healthcare and Tenet Healthcare, fell today after reports indicated that Republican congressional leaders are considering a Medicare pay cut for hospitals as counterproposal to Democrats' demand to renew Obamacare subsidies. HCA Healthcare, ticker HCA, fell 4% today. That policy was included in a list of healthcare options presented to Republican House members in a meeting today. This according to a document viewed by Bloomberg. It could lower costs for patients and save the Medicare program substantial amounts of money, but it has been opposed to hospitals due to the higher overhead costs. And finally, the parent company of Instacart, Maple Bear, down 6% today. It was one of the numerous online gig economy stocks that took a hit, including Lyft, Uber, DoorDash, and more. This after Amazon said its expanded same-day delivery offering for perishable groceries to over 2,300 cities and towns.
Oracle earnings crossing the wire right now. Let's get right to it here. It does look like the top and bottom lines are meeting. Second quarter numbers up about 14% on the revenue side to roughly $16 billion, though that does look like it's just a tad light. The street was looking for $16.2 billion. Revenue on a constant currency basis up 13%. That's also light. The street was looking for roughly about 14.6. We'll round that up to 15%. EPS in the quarter, $2.26 a share. That is a beat, a sizable beat. The street was looking for $1.64 here. I'm not seeing a guidance just yet here, but we should point out that cloud revenue was up 36% in the most recent quarter. Cloud infrastructure revenue, a separate category, that was up 71% in the most recent quarter, and cloud application revenue was up about 11%.
All right, let's take a quick look at Adobe. Those earnings also crossing the wire here. Adobe shares higher by about 2% after reporting that fourth quarter adjusted EPS beat the estimate. The numbers there for fourth quarter adjusted EPS coming in at $5.50. The estimate had been for $5.39. Also, fourth quarter revenue coming in ahead of expectations as well. You take a look at the guide here. They see first quarter revenue between $6.25 billion and $6.3 billion. The estimate had been for $6.24 billion. So the midpoint of that range comfortably ahead of the estimate. They also see first quarter adjusted EPS between $5.85 to $5.90. The estimate had been for $5.66. So looks like a beat and raise quarter there. You can see that reflected in Adobe shares after hour, higher by about 2%. We know this company has been pretty beaten up in the stock market this year.
I'm getting back to Oracle and looking at the commentary. Lots of commentary coming from executives at the company. Oracle CEO Mike Sicilia is saying that AI training and selling AI models are very big business, but we think there's an even larger opportunity embedding AI in a variety of different products. Oracle is in a unique position to embed AI in all three layers of our software products: cloud data center software, autonomous database and analytics software, and our application software. Shares of Oracle down about close to 6% in the after hours.
All right, let's get to the application software company Synopsys. It is also reporting its results and into the outlook. Let's start there. Sees first quarter revenue of $2.37 billion to $2.42 billion. The estimate on the street is $2.36 billion. First quarter adjusted EPS, again to the outlook, $3.52 a share to $3.58 a share. Estimate on the street is $3.46. So it does look like it's bumping that higher, and we do see the stock up 2.6% in the aftermarket. 2026 revenue, $9.56 billion to $9.66 billion. That compares with $9.63 billion in terms of the estimate, and it sees 2026 adjusted EPS of $14.32 a share to $14.40. That too is handily above the street estimate of $14.11. So again, that stock up about 2% in the aftermarket. And fourth quarter revenue, just for some growth year over year, up 38%, and fourth quarter adjusted EPS. So a look back at the quarter that was $2.90 versus $3.40 year over year, but nonetheless tempering some of its gains in the aftermarket, but still up, you guys, about 1% here.
Absolutely. And we go back to, of course, Oracle, which obviously sort of is kind of the fulcrum for everything that we're reading now with regards to Synopsys, Adobe, and the rest of that AI trade. And I was looking through their presentation on their website, and they talk a lot about the new customers that they've signed up in the most recent quarter for their services. But a big part of this, and a big part of why you're seeing the shares down, there's a lot of concern about Oracle's ability to fund that. Remember, unlike some of the hyperscalers and the others that we've talked about who've been able to fund their AI dreams primarily with their own cash on the balance sheet, Oracle has relied on a big way on the debt markets, and the expectation is they will return to the debt markets to fulfill some of those obligations, and some big questions here about whether that erodes profitability.
All right, you guys are talking tech. I'm also looking at what's happening in the ski business. Vail Resorts reporting down just about 1% in the after hours. First quarter net revenue missed estimates. First quarter total skier visits came in above estimates. First quarter loss per share came in slightly above estimates at $5.20. Once again, shares of Vail Resorts down about 1.1% in the after hours.
All right. And back to Adobe, it is up about 2.6% here in the aftermarket, and we're looking at Oracle under pressure, continuing to see it trade lower here in the aftermarket. It is down about 5.1%. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on the close on TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
All right, stick with us. Our coverage continues here on the close with a focus on those results that we just got out of Oracle. We're going to talk to Brent Thill, tech sector leader of software and internet research over at Jefferies. We should point out Oracle shares down about 6% and is dragging a lot of the AI cohorts down with it, including names like CoreWeave, TeraWulf, as well as PureSword and Applied Digital. That conversation coming up after the break. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. One of the more meaningful updates that we've had in equity markets coming off of that Fed meeting, the Fed press conference, and maybe a little bit more conviction here about what comes next. The S&P 500 up about 0.7%, though it did close just shy of its all-time high by a couple of points or so. Meanwhile, the Russell 2000 did notch a fresh record high, adding about 33 points or 1.3%. We also saw the KBW Bank Index move higher as well into record territory. And keep an eye on yields. We actually saw today, for the first time in quite some time, a drop in short-term yields. But that, of course, means a steepening of the yield curve. We're now back on the 210s to some of the steepest levels since early September, late August.
And we did get some interesting tech earnings after the bell. Let's take a look at those after-hours movers right now. Taking a look at Adobe, I'll start there because initially we saw a big pop in Adobe shares after the close. It was a beat and raise quarter for this company. You can see, though, that those gains reversing. And Oracle down about 5% right now. Their second quarter adjusted revenue actually met expectations. Their backlog numbers coming in pretty good as well. But certainly, Romain, this is a company with pretty high expectations on the street.
Yeah, a big beat on the bottom line with regards to profitability here. Adjusted EPS at 226. The street was looking for 164. Revenue pretty much in line with estimates, up about 14%. But you just mentioned it, Katie, that backlog, $523 billion worth right now, sitting there for the taking. Brent Thill joins us right now, tech sector leader of software and internet research over at Jefferies. And let's start off with that backlog, Brent. I know that number looks big. I guess the big question is, do you think Oracle is going to be able to fulfill it?
Yeah, that's the billion-dollar question, and we won't know for years because the OpenAI relationship is going to take, several years to fulfill. So if you're an investor, you're excited because the backlog isn't going to go down because they can't take it to revenue. The fear short-term is can actually they deliver on this infrastructure? And when they signed that $300 billion deal last quarter, I think, many of us asked that have followed Oracle for many decades is like this contract's, 5 times the size of your annual revenue stream. How do you deliver on something so big? Little did we know that the street would be so focused and so negative on this. And you can see the negativity of that continuing to present an overhang on the stock. So I think that the challenge with this quarter was it was an okay quarter, but there was no massive elephant, transaction. You kind of had the antelopes, if you will, roaming, not the elephants. And you had a good print overall. Just things were kind of in line where the street wanted. Last quarter was obviously a blowout. So I think the challenge is there's not many $300 billion deals out there, and there's incremental revenue to be had. But who's gonna come over the top on OpenAI on a transaction that big? So that's the challenge for Oracle in the short term.
Do you actually see their customer base broadening a little bit, specifically for the cloud AI products?
Yeah, I do. I mean, the beauty is they run Uber, they run TikTok, they run some really meaningful companies. They run many of the top banks in the world, insurance companies. And I think the fact when you can win a deal from the #1 AI company in the world, which is OpenAI, it tells you that if they're going to let that Oracle deal with the data, that everyone else should deal with the data. And this goes back to the founding of Oracle at the CIA. This company is effectively the underbelly of every major corporation that's out there. And there was worry in cloud and the worry in SaaS that data was going to go somewhere else, and Oracle's hung onto that data. And now They're creating a great bridge to the cloud. They're creating a new AI avenue. So our belief is that they will broaden, and this is global. In Europe, in Asia, they're getting some great wins. We'll hear more about that on the call, but we definitely think the base is broadening at Oracle. And again, when you get a vote of confidence of a company that knows more about data than anyone, hands Oracle that level of a check. And they handed Microsoft a $250 billion backlog contract as well.
Right.
Yeah. There are only a few companies on your hand that can actually do this, and Oracle is one of only a few.
And Brent, I want to talk a little bit about the debt side of things, because you think about the fact that Oracle's free cash flow expected to be negative for several quarters here, potentially the next couple of years. You think about their credit risk reaching the highest level since 2009 last week. As someone who covers the equity, Oracle equity, how are you thinking a little bit about the debt component here?
Yeah, I mean, it's a concern. They have a high debt load already, and we've been flagging this. The debt load's has been a concern for a while, and now it's even a bigger concern. So we're conscious, and we view it as a risk factor, but I think much of the OpenAI contract has been stripped out of the stock, out of the equity. And so if they win more deals with others, we think that can get restored back into the equity. But I think what OpenAI and many have said is that they can fund this. They believe they can fund this. I would say the announcement yesterday by OpenAI announcing Denise Dresser as the head of sales gives you further conviction, if you're an Oracle equity investor, that she's one of the best enterprise reps on the planet. And Sam Altman picked her over everyone else. And having her, the keys to OpenAI is the enterprise. And if they can get these enterprise contracts going, not just us paying $30 a month to OpenAI, but they get my firm and your firm to pay, that's where the funding is going to come for Oracle. So I have even more conviction now that they can do this with her arrival, and I think there's going to be other data points along the way that will leave, I think, some of the debt holders a little more comfortable that they can make these payments. And again, remember, Oracle's sitting on a very high margin software business. This isn't CoreWeave, where you have a lower margin infrastructure business. You have a very high margin software business that generates a lot of cash flow, and so they can back off the investments very quickly and move quickly to cash flow positive if they want to pull back the infrastructure build out, because they have a great apps business, they have a platform as a service business. So that's something to keep an eye on as well.
All right, Brent, unfortunately, got to leave it there. Really appreciate your quick insight there. That is Brent Thill. He is tech sector leader of software and internet research over at Jefferies. Now coming up, the founder of Cleo Capital, Sarah Kunst, joins us next to take a closer look at today's tech earnings. This is The Close. Another check on earnings and the AI trade. Shares of Synopsys in particular, you can see flying right now after reporting earnings just moments ago. Also keeping an eye on shares of Oracle and Adobe. Let's discuss it all with Sarah Kunst. She is managing director and founder over at Cleo Capital. Sarah, it's great to have you with us. I want to start with Adobe because initially you saw a pop. The numbers that Adobe delivered were pretty good, especially when it comes to the outlook on sales and revenue. Now we're turning lower in the after hours trade, and it just feels like sentiment on this stock has been so negative for so long here.
Yeah, it's interesting because when you look at that sort of analyst average price target, it's quite a bit higher than where Adobe's trading right now. But I think the reality is that we see all of these new tools. Google just came out with Nana Banana Pro, and it's really hard to see a ton of growth ahead for their core business, for that subscription around a lot of their creative tools.
Yeah, and you think about, that partnership, you want to call it that, announced earlier today, Photoshop and Acrobat going to be integrated into ChatGPT. It's going to be offered free to chatbot users. The hope there is that its features are going to be seen by a wider audience, kind of increasing the visibility. If you're Adobe, what else is there to do than try to broaden the net, even if you're offering it free?
Yeah, and I think that's the scary part, right? They don't have a business model that makes them a lot of money with people using it for free. There's not necessarily a lot of network effects there. And so, yeah, this might get them more eyeballs, but it feels like it might be a little bit of a better deal for OpenAI than it is for Adobe. And so I think there's concern about sort of this dwindling. We hear about, AI is going to take all these creative jobs. Those creatives, the photographers, the graphic designers, are the people who are paying often a lot of money to Adobe. And so what happens when they don't have that money anymore? And the reality is it could lead to a long time downturn in sales.
Yeah, and it gets to this idea too, Sarah, about these companies that are trying to sort of transform for the era. And we know that Adobe has had some success, obviously, in moving to that subscription model. But when you look at some of their competitors, particularly some of the upstarts coming in here, is there a case to be made that there might be better value in those names than in Adobe?
I certainly think that could be true. Canva is a privately traded company, but they've done a great job at just sort of creating things that are lower touch, easier to use, cheaper. Figma has some of that as well, and those companies haven't been around as long. But when you look at their growth, I think that a lot of the excitement and interest in the space does sort of shift over. And then the reality is that even the Apples of the world do a pretty good job of having a great camera where you can take a great picture, and then they have some neat sort of baked in photo editing tools, or Instagram. And so I think some of it is that we no longer are looking for the same level of quality in some of these tools, and so we're perfectly happy with what's baked in or provided for free.
I want to get your thoughts real quickly here on Synopsys. Not a name that we talk about a lot, but the shares having a pretty good after-hours session, up about 8%. And it gets to this idea that some of the plays in the AI, and let's just call it the broader cloud space right now, aren't necessarily through the data center operators or even the hyperscalers. Some of it is in these second-tier companies. I don't know if you had a chance to look at the report that we just got out of them, but what is your general outlook for where this company and where management can actually take it?
I think that in general, when a shiny new object pops up, can you trust Jensen that, hey, they put a bunch of money in, there's probably some there? Absolutely. Should you YOLO completely into that name, sight unseen? Maybe not, right? Maybe take a minute, read some of their old filings, right? Be able to tell your family at dinner, hey, well, this is what these companies actually do. And so I think we're seeing some of that pile on trade, some of that excitement of people trying to catch the upside, driving it higher. But then you kind of plateau out and say, is this company really that different than it was 2 weeks ago? And now I think it's up something like 15% from them. And so there is, in my mind, just a question mark of, is there too much momentum in some of these sort of second tier names, as you call them?
And Sarah, we have less than a minute left here, but let's quickly talk about Oracle posting disappointing cloud revenue. You can see the shares taking a hit after hours. What would you want to hear from executives on the call?
I think that people want to know who they're going to sell to, who actually has the money in the bank to buy what they are selling, because that is not OpenAI.
All right, Sarah, always great to catch up with you. Sarah Kunst, Managing Director, Founder over at Cleo Capital, as we continue our coverage deeper into the results that we just got out of three big tech names, but none more important than Oracle. We've seen the revenue growth, we've seen the profit beat in the most recent quarter, and we've seen that more than $500 billion backlog. But the big question is, how do they pay for it all? There's a credit risk concern out there, and we have that discussion when we come back after the break. Taking a look at shares of Oracle in the after hours trade down about 6.5%, Katie, and that's dragging some other names down, particularly some of those neo clouds like CoreWeave.
Yeah, absolutely. A lot to dig into when it comes to Oracle, when it comes to free cash flow, when it comes to customer concentration risk, and of course, we're going to dig into those credit concerns up next. This is The Close.
All right, 3 months ago, Oracle reported earnings, and it saw a more than 30% jump in the stock in one day. The shares in the after hours traded down about 6%, adding to what has now been a more than 30% drop in that stock since its September highs. A lot of this, so of course, surrounding a lot of the concerns about the potential of a bubble growing in the AI space. This, just as of last week, the cost of protecting Oracle's debt against default hit its highest level since 2009. 24 Asset Management taking note, writing the pockets of risk, particularly in the rapid scaling of AI-driven issuance, in investment grade will require elevated due diligence. Here to talk a little bit more about the debt side of the Oracle story is Will Smith, AllianceBernstein Senior Vice President and Director of Credit. And Will, I do want to start with this. I mean, Oracle's already gone to the bond market. I mean, so far, investors have digested that. But the idea that when you have a company sitting on a $500 billion backlog that we know, at least looking at its balance sheet, it can't necessarily fulfill based on the cash on hand. How much does Oracle, and for that matter, some of its peers, going back into debt markets become a credit event for everyone else?
So Oracle really matters because it is the quote unquote harbinger of the AI CapEx boom. So investors are really focused on everything that Oracle has to say, and crucially, how they plan on financing the amount of CapEx that's going to be required for this generation of AI build. Now, what we think gets lost a bit is that investors are being skeptical in a lot of different ways, and we think this repricing in debt markets is very consistent with the view that risks are building. There's more uncertainty about the payback period, the amount of CapEx, and the financing of that CapEx going forward. And to us, that's a very healthy dynamic for debt investors.
So a healthy dynamic for debt investors. Do we have to worry at all about the idea of credit quality or the complexion overall changing because of some of the, and obviously we're talking hypotheticals here, but some of the new issuance that is likely to come down the pike?
We, of course, have to be concerned about it. I mean, as debt investors, that's really all we're doing is pricing what we think the downside risks are. And in this case, it is a little bit unique versus history because that risk is really building in the investment grade universe in some of the very best, most cash generative companies in the U.S. today. And that's different than other big CapEx booms. So in our view, that means the risks are really around credit downgrades. And we talk about Oracle and some other names. Maybe they're not as high quality as single A plus as they've been in the past, but maybe they're moving towards low triple B, high double B, and that requires a repricing of that risk. That's a different risk profile for investors. That gives investors who are willing to be a little bit more provocative an opportunity. And we think the recent repricing in most of these hyperscalers is a pretty good opportunity for debt investors to step in.
Interesting. So just to make sure I'm understanding you, Will, so when you see some of those names, some of those hyperscalers who have been tapping the bond market in a big way come under pressure, it sounds like that would be a buying opportunity to your eyes.
It does. And I think the crucial element here is these companies are not likely to spend all of this CapEx without some more clarity about what the payback period will be on these businesses. So I think in a lot of ways, investors are concerned that the payback period is super uncertain and these companies are going to spend all this capital for the next 5 to 10 years, regardless of what the payback period looks like, what that revenue capacity really actually is. And we think that's a little bit backwards. These companies are likely to spend this much money if the revenues and earnings follow these models and really accrue to these companies. And so we think that there's a little bit of a path dependency here that investors are missing.
And I do just want to talk about supply overall. Again, a lot of this conversation is happening in the U.S. investment grade universe. You take a look at the house view over at TD. They would expect to see IG sales hit a record of $2.1 trillion in 2026, fueled by what we're talking about. Their view is that high-grade spreads could reach a base range between 100 and 110 basis points, which isn't that high in the grand scheme of life, but you consider where we are right now on spreads around 80 basis points. Will, does it seem reasonable that we could meaningfully go above 100 next year?
It certainly could happen, Katie. We think it's probably unlikely that it happens just because of supply issues. Supply is generally the mechanism that kind of corrects markets. So when we feel really good about the economy, growth, and corporate earnings, we see more supply as a result. But if we start to feel less good about the direction of the economy or corporate earnings, then supply will start to decrease. And so we think that it's likely that spreads go wider at some point, but it's probably because we get concerned about growth at some point.
Is there any sense, any sort of tie-in with Fed policy and the idea of at least what we learned today and the idea of what the market has been trying to price in for 2026?
For sure, there's a tie-in. And when we think about what companies and investors are expecting for next year, in a lot of ways, you could be extremely excited about that outlook, because you're seeing actually a pretty large fiscal stimulus come through next year at the same time the Fed's cutting rates. And we also have this manufacturing and CapEx resurgence as a result of artificial intelligence. So that could be a pretty positive dynamic for investors. And I think a lot of folks are looking at potential M&A activity, and they're saying, well, I can probably buy these assets for a better price today than I might be able to in the next few years. And if I expect my cost of debt to move lower over that same time period, then that's probably my best opportunity to get these big M&A deals done. So we're likely to see a lot more of that happening.
And it's interesting, Will, how private markets factor in. You point out in the notes you sent over to our producers that private investment grade funding will remain central to this AI build out. And increasingly, I mean, you think about issuers hopping back and forth between private and public markets to get this funding. It feels like that line is blurring.
It for sure is blurring. The reality is the private credit market is now a really substantial part of how companies think about financing their businesses, and that is really unlikely to change. And when we think about the AI CapEx spend, it's going to require a lot of different types of capital to really achieve what we think will happen. So that's going to require private credit markets to look at deals and structured in a way that makes sense for them, bond markets, loan markets to also participate, and also for securitizations to happen, as there's a lot of infrastructure that's required to make this happen.
All right, Will, great to check in with you. Really appreciate your time. That is William Smith. He is AllianceBernstein Senior Vice President and Director of Credit. Meanwhile, let's take a look at the equity market reaction to that earnings report. You take a look at Oracle shares falling after hours. And it's not just Oracle, which is interesting, because you're also seeing shares of CoreWeave and NVIDIA move lower as well on the heels of that report, Romain.
Yeah, and it gets to the idea of whether maybe people are throwing the baby out with the bathwater. Oracle is definitely a very unique situation. Obviously, it's sort of like an embarrassment of riches right now for this company, but one, they have to find a way to fund in a way that's actually going to be palatable to investors. Meanwhile, some of those other names, you know, I mean, there's really no sense, at least right now, that they're having any kind of funding issues. And obviously, we get back to your, you know, Ouroboros. I'm going to learn that word at some point in 2025.
I knew in my heart you were going there.
But there is a lot of support. We're talking about Synopsys, of course, the big investment that NVIDIA made there. And of course, we talk about the double dealing to a certain extent, which for some people is a bad thing, but some investors see it as a good thing, at least one that keeps, adds some support to some of those names.
Absolutely. We'll continue to follow, of course, that daisy chain. I will point out Adobe shares poking into the green. This is the close. All right, let's get back to that Fed decision. The S&P 500 posting its biggest Fed day gains since March, closing in on record highs yet again after the third straight interest rate cut in a row. Fed Chair Jerome Powell forecasting solid growth in the year ahead, saying that the economy is in good shape and that the Fed is, quote, well positioned to wait after what could be the final cut of his tenure as chairman. Joining us now, I'm pleased to say, is former Boston Fed President Eric Rosengren. Great to have you with us. I want to start with the dissents. This was a 9-3 vote, 3 dissents. This was the first time since 2019 that you had 3 officials vote against the decision, and you had this on both sides of the policy spectrum. I know that the 3 dissents in particular were perhaps expected here, but if we continue down this path, if we see more discord among the FOMC, at what point does it start to become counterproductive or start to complicate the Fed's messaging here?
I don't know whether it affects the Fed messaging, but I think it makes it much more challenging for whoever the new Fed chair is, that there's a committee that doesn't seem particularly inclined to significantly decrease interest rates over the course of next year. So with this dissent, there were 2 presidents and 1 governor. The governor, Myron, thought that there should be a deeper cut. And the 2 presidents, presumably concerned about inflation being too close to 3%, not close enough to the 2% target, were worried that we weren't putting enough weight on inflation, and as a result, dissented for no change.
It was interesting, too, to hear Jerome Powell weigh in during the Q&A saying that, you know, there are arguments on both sides when you consider both sides of the mandate, and they have one tool, one lever, which they can pull. And I wonder, you know, how you see that balance right now when it comes to inflation, but also the trajectory of this labor market.
Well, I think he characterized it very accurately. Inflation's definitely much higher than the target and hasn't been moving in the right direction. So those people that are concerned about the inflation part of the mandate have a very credible argument. But I would say also on the employment side, one of the reasons this is difficult is because the unemployment rate has been gradually rising. The chair highlighted the payroll employment, given some adjustments, seemed quite weak. And as a result, he thought a little bit more insurance was appropriate. So I think people could easily disagree with the findings of the FOMC this meeting. And I think it's shown actually in both the dissents, but also a number of presidents who were not voting members indicated they didn't think that it was necessary to cut rates this meeting. So there were 6 participants in the FOMC who said that they thought under appropriate policy we didn't need to cut. So presumably that was the 2 presidents that dissented and then 4 other presidents who agreed but didn't have a vote.
Does it matter at all, Eric, this idea of Jay Powell being a lame duck? Not my words, but we've seen this phrase battered around, and the idea that could affect the next 3 meetings in 2026 before we actually get a changing of the guard in May.
I think the current chair is going to do exactly what he thinks is appropriate policy until he's no longer chair. So I don't think he's a lame duck in that respect. But I do think he highlighted that he wanted to hand over an economy that whoever the new chair is felt comfortable with. I do think that it's going to be a more difficult committee to manage for the next chair than the current chair.
One aspect of this particular Fed decision that jumped out at me was the resumption of the Treasury bill buying. And I know that's kind of a separate sort of a function, if you will, than what they're doing with rates itself. But I am curious as to what it says about the ending or the curtailing of quantitative tightening to begin with, and whether it was appropriate to effectively tamp that down when they did, or whether they should have let it keep going.
Well, I think what they're indicating, and so first of all, this is a technical adjustment. I wouldn't view it as a policy change to start purchasing Treasury bills, which expands the balance sheet. I think what they're saying is that the Fed funds rate was trading fairly high, which meant that reserves are currently a little bit more restrictive than what they would like to see. And so as the economy grows, they need to grow reserves. And they don't think that the balance sheet has room to shrink further without disrupting short-term credit markets.
And I do want to talk a little bit more about the direction of travel when it comes to 2026, because you take a look in the new dot plot in terms of the median projections. It seems like we're looking at 1 rate cut for the totality of 2026, 1 in 2027. Of course, we know things can shift around, and they often do, but do you think at this point where we are when it comes to the mandate, when it comes to where inflation is, where the labor market might go, that the possibility of a rate hike should be entered into the conversation, especially when you think about the global central bank picture right now?
I think it's a little early to be calling for any kind of rate hike, but I do think it's a situation where they would need some significant weakening of the labor market to feel like additional easing was necessary. And I think that you're seeing with only 1 cut that is a bit less than what the market was anticipating in the Fed funds futures, and is probably quite a bit less than what the administration's hoping for.
Going back to just the state of the economy, Eric, and as this market really tries to get a handle on whether the market needs more rate cuts or maybe just potentially leaving rates where they are. Jay Powell kind of alluded to the lapse of economic data over the last few months, and the idea that there's going to be a big catch up, some big revisions as well. But the net effect of it, at least in his words, seemed to suggest that the labor market might actually be weaker than at least what we know now based on the data. If that does indeed prove to be the case, how quickly, or more importantly, what tools does the Fed have to address that in an efficient way?
Well, the main way that the Fed has to respond to a much weaker economy would be to lower interest rates much more than they currently anticipate. So the median rate cut was for only 1 cut. if we really start to see the unemployment rise quite quickly, which I don't think is anticipated by the committee, and I don't anticipate it either, then the appropriate response is to try to lower interest rates enough that it takes care of demand.
All right, Eric, always appreciate you taking time for us. Former Boston Fed President Eric Rosengren there. A closer look at the big Fed decision today. And when we come back, we're going to push ahead to tomorrow and what also can move the market. Stick with us. This is Bloomberg. All right, welcome back. We want to focus in on that Warner Brothers Discovery deal, or maybe no deal. President Trump weighing in, saying in a Q&A with reporters earlier that any Warner Brothers purchase must include the sale of CNN. It adds a little bit of intrigue here to the two competing bids for the company. Bloomberg's Chris Palmeri joins us right now. And Chris, first, let's start off by going back in history, way back in history, to 5 days ago, when it looked like Netflix actually had this in the bag with a bid that seemed pretty rich at the time. Of course, Paramount came in a little bit later after that, upped the bid. And now we see the campaign from Paramount to shareholders, and what seems to be maybe a little bit of a campaign coming out of the White House. What's going on?
Yeah, well, we've known that David Ellison was working both Washington and Wall Street over the past few days. He was at the Kennedy Center Honors on Sunday. He talked with the president there. He had the head of the FCC in his own box at the show. And then he made his way to Wall Street. He was at the UBS conference yesterday. He met with investors. Seems to have done a pretty good job. We interviewed Mario Gabelli yesterday, and he said he was very impressed with the Paramount offer. You saw the Paramount stock rise. It's almost at where the $30 a share that the Warner Brothers shares rise. So there does seem to be a little anticipation among investors that the price is going to climb if Paramount makes another offer.
And it's worth pointing out that President Trump's son-in-law, Jared Kushner, has also been reportedly involved in setting up financing for that Paramount competing offer. So, I mean, what do you think that Netflix's response is here? Could you envision a world in which Netflix includes the cable networks as part of its bid?
No, in fact, I think the president probably didn't understand that under the Netflix proposal, they're only acquiring the film and TV studios and the streaming businesses of Warner Brothers. And the cable channels are to be spun off next year before they close that deal. So they would not be acquiring CNN. Paramount would be.
Yeah, that seems to be lost in the shuffle here, Chris. But again, we know that this has now become a political issue. I am curious about the pressure that Paramount is now putting on shareholders, out with the letter today talking about the idea that their offer is superior, and we can go through all the superlatives here. But it kind of circles back to a question here about what Warner Brothers should really be valued at. I mean, it's one thing to throw these numbers around, but if you end up paying, $30 or more, $100+ billion or more, you have to have a return on that. At least investors are going to want to see a return on that. And I'm having a hard time making that math actually math.
Well, one thing that investors are looking forward to is in a few weeks, Versant, which is the cable TV spinoff of Comcast, is going to start trading. And depending on how that's valued, it'll give investors a sense of what Warner Brothers cable channels will be valued at. And that's sort of the big difference between the Netflix and the Paramount offer. Paramount's paying all cash for the whole company. Netflix only wants, as I mentioned, the streaming and studio assets. And so that investors will know kind of what the remaining parts are worth. So that'll be the big sort of moment in a few weeks.
And Chris, of course, no one knows what truly is going to happen, but it seems like the one consensus is that this is going to take a while. What are your sources telling you for what kind of potential timeline we could be looking at here with this deal?
Well, just if there was no fight, the regulatory issues would stretch a year or more. This requires approvals all around the world, countries, states, and that. But given that there is a fight, it certainly seems like the Paramount tender offer expires January 8th, I think, and that could be extended. They could up their bid. Netflix could up their bid. It's from what we're hearing, this won't be decided this year.
Well, yeah. There's 3 weeks left, Chris.
That would be
Come on.
amazing.
Chris, always love catching up with you. Chris Palmeri, our man out there in Los Angeles, a closer look at what could potentially be the deal of the year, or I guess now the deal of 2026.
Yeah, right.
Warner Brothers Discovery. All right, let's push ahead here. We have a lot going on tomorrow as well that could potentially move the market. That includes more earnings. We were talking today, of course, Katie, about Oracle, about Adobe and Synopsys and the AI trade. We get another read on that trade tomorrow with Broadcom.
Yeah, we will certainly have a lot to talk about when it comes to Broadcom. Also, Costco, an interesting story there.
Yes.
Lululemon. I'm really excited for that. And RH as well. I know that that's a company you follow.
This is a rare trifecta here. I've actually been in all 3 of those stores. Costco only twice. Costco scares me. Lululemon was okay. RH, I like RH, but none of that stuff fits in my apartment.
No. So. Do you have any Broadcom chips?
Not yet, but I got to get on that. You know, Christmas is around the corner, Katie.
That's
if you want to treat
true. That's true.
Maybe you don't have to go for the Blackwell. Maybe H200 or something. You know, save a little money. Initial jobless claims tomorrow. Trade balance if you care. Rivian Autonomy and AI Day, and Katie Greifeld.
Yeah.
I'm told that tomorrow Time will announce you as the person of the year.
Wow, you heard it here first on the close. Looking forward to that announcement. I believe it was Donald Trump, right, last year.
It was Donald Trump last year. A lot of intrigue as to who it will be this year. Who is the most important person of the year, Katie?
This is the close.